Hello, and welcome back to Boni's Life, your home for the most advanced and insightful analysis of the global financial markets. This is the channel where we dissect the complexities of the crypto space, providing you with the knowledge to navigate these volatile waters with the precision of a seasoned professional. Today, we are embarking on a deep dive into the tumultuous crypto market of the past week, a week that has tested the resolve of even the most ardent believers in this digital revolution. We will dissect the market's every move, from the macroeconomic forces shaping its trajectory to the intricate technical patterns that offer clues to its next direction. We will explore the fundamental drivers, the geopolitical undercurrents, and the psychological warfare that defines this market. And as always, we will provide you with actionable insights and potential trading scenarios to help you stay ahead of the curve. So, buckle up, because we are about to embark on a journey into the heart of the crypto market, a journey that will leave you with a profound understanding of the forces at play. Let's begin with a look at the big picture. The past week has been a roller coaster of emotions for crypto investors. We've seen moments of deep despair, followed by glimmers of hope, all within the span of a few days. The total cryptocurrency market capitalization currently stands at approximately $3.19 trillion, a figure that, while staggering, represents a slight contraction of 0.3% over the past 24 hours. This is a market that is still reeling from the shocks of the past several weeks. Bitcoin's dominance remains firm at 57.1%, a testament to its enduring status as the king of crypto, while Ethereum maintains its position as the second largest cryptocurrency with a dominance of 11.4%. However, the most telling metric of the week is the Crypto Fear and Greed Index, which has plummeted to a chilling 12, indicating a state of extreme fear. This is the lowest reading we've seen all year, a clear signal that market sentiment has capitulated. But as seasoned investors, we know that moments of extreme fear can also be moments of extreme opportunity. It is in these moments that the weak hands are shaken out, and the strong hands position themselves for the next leg up. This is not a time for panic, but for calculated analysis and strategic positioning. The 24-hour trading volume across all cryptocurrencies stands at a robust $112.32 billion, indicating that despite the fear, there is still significant liquidity and activity in the market. Now, let's dissect the week day by day to understand the intricate dance of the market. Our journey begins on Friday, November 21st, a day that will be etched in the memories of many crypto traders. This was a day of reckoning, a day when Bitcoin plunged below the critical $86,000 level, a support that many had hoped would hold. This was a direct consequence of a wave of selling from medium-term holders, those who had purchased Bitcoin in the preceding months and who, spooked by the relentless decline, decided to cut their losses and exit their positions. The market was a sea of red, with the total crypto market cap shedding a staggering 6% in a single day. Ethereum too felt the pain, dropping below the psychologically important $3,000 level, a threshold that had provided support for much of the year. The selling pressure was intense, and it seemed as though the market was in free fall. The weekend brought little respite, with the market trading sideways in a state of nervous anticipation. Traders were glued to their screens, waiting for any sign of a reversal or further capitulation. The low volume typical of weekend trading added to the sense of unease, as even small orders could move the market significantly. Then came Monday, November 24th, and with it, a glimmer of hope. As the traditional stock market rallied, buoyed by positive sentiment ahead of the Thanksgiving holiday, a sliver of optimism returned to the crypto space. Bitcoin clawed its way back to the $88,000 mark, a small but significant victory for the bulls who had been battered and bruised by the preceding weeks of decline. This move was not driven by any fundamental news, but rather by a technical bounce and a sense that the market had perhaps become oversold. Ethereum also participated in the rally, moving back above $2,900, though it remained well below the $3,000 level. Tuesday and Wednesday were characterized by a tense standoff between buyers and sellers, with Bitcoin hovering around the $87,788 level. The market was consolidating, digesting the recent moves, and waiting for a catalyst to break the deadlock. There was a palpable sense of anticipation in the air as traders debated whether this was a genuine bottom or merely a temporary respite before another leg down. The trading volume during these days was relatively muted, suggesting that many participants were sitting on the sidelines, unwilling to commit capital until the direction became clearer. That catalyst arrived on Thursday, November 27th, Thanksgiving Day in the United States. As Americans gathered with their families to give thanks, the crypto market staged a surprising rally. A wave of fresh buying pressure, possibly from international investors or from those who had been waiting for a dip to enter, propelled Bitcoin back above the crucial $91,000 resistance level. This was a significant psychological victory for the bulls, as it demonstrated that there was still demand for Bitcoin even after the recent carnage. Ethereum also benefited from the rally, climbing back above $3,000 and closing the day at around $3,015. The move was accompanied by a noticeable increase in trading volume, suggesting that this was not just a short squeeze but a genuine shift in sentiment. And today, Friday, November 28th, we see Bitcoin consolidating its gains, trading at a respectable $91,355. Ethereum is holding steady at $3,019, up 0.4% on the day and an impressive 8.1% over the past 7 days. It has been a week of intense volatility, a week that has separated the speculators from the true believers, and a week that has provided valuable lessons for all participants in this market. To truly understand the events of the past week, we must look beyond the charts and delve into the fundamental forces that are shaping the market. The specter of the Federal Reserve looms large over the crypto space, as it does over all risk assets. In October, the Fed cut interest rates by 25 basis points, bringing the federal funds rate down to a range of 3.75% to 4.00%. This move was repeated in November as the Fed continued its gradual easing cycle. These rate cuts, while intended to stimulate the economy and support the labor market, have created a sense of uncertainty in the market. The problem is that the Fed's own members are now divided on the appropriate course of action. The minutes from the most recent Federal Open Market Committee meeting revealed that many officials did not think the central bank should lower interest rates in December, citing concerns about persistent inflation. The Consumer Price Index, a key measure of inflation, remains stubbornly high at 3.0%, well above the Fed's 2% target. This has created a mixed signal environment, leaving investors guessing about the future of monetary policy. And as we know, crypto, like other risk assets, is highly sensitive to changes in interest rates. When rates are low, investors are more willing to take on risk, and capital flows into assets like Bitcoin and Ethereum. When rates are high, or when there is uncertainty about the direction of rates, investors become more cautious, and capital flows out of risk assets and into safer havens like government bonds. The easy money era that fueled the last bull run is over, and we are now in a new paradigm. A paradigm defined by macroeconomic uncertainty and a more hawkish Federal Reserve. But the Fed is not the only actor on this global stage. The ongoing trade tensions between the United States and China continue to cast a long shadow over the market. The flash crash of October 10th, triggered by President Trump's renewal of the trade war with China, serves as a stark reminder of how geopolitical events can send shockwaves through the crypto space. On that fateful day, $19 billion in crypto was liquidated in a matter of hours as leveraged traders were forced to close their positions. The event was a brutal lesson in the interconnectedness of the global financial system and the dangers of excessive leverage. And let's not forget the other geopolitical hotspots around the world, from the Middle East to Eastern Europe. These conflicts create a flight to safety, a rotation out of risk assets like crypto and into traditional safe havens like gold and government bonds. The regulatory environment also remains a key concern for crypto investors. The Securities and Exchange Commission's continued scrutiny of stablecoins, coupled with the alarming rise in crypto theft, has created a sense of unease among investors. According to a report by blockchain analysis firm Chainalysis, nearly $3 billion of cryptocurrency was stolen in the first half of 2025 alone, a staggering figure that highlights the security challenges facing the industry. Tether, the largest stablecoin by market capitalization, is now facing scrutiny from S&P Global, a development that could have far-reaching implications for the entire crypto ecosystem. If Tether were to face regulatory action, or if its peg to the US dollar were to break, it could trigger a massive sell-off across the entire crypto market. Now let's turn our attention to the technicals, to the language of the charts, which often speaks louder than words. The recent price action has been a masterclass in technical analysis, providing valuable insights into the market structure and the balance of power between buyers and sellers. Bitcoin's 2-year uptrend, which had been a source of comfort for many investors, is now under threat. The price is precariously perched above the 50-week simple moving average, a key technical indicator that has historically acted as a strong support level during bull markets. A break below this level could signal a prolonged bear market, a scenario that many are hoping to avoid. However, the liquidation heat map from CoinGlass tells a fascinating story. It reveals large clusters of liquidations at key support and resistance levels, indicating that the market is being driven by large institutional players who are using sophisticated trading strategies. These whales are not panicking, but rather they are strategically positioning themselves for the future. The volume profile also suggests that these institutions have been accumulating Bitcoin at lower price levels, particularly in the $80,000 to $85,000 range. This is a sign that they are not bearish on Bitcoin in the long term, but rather they are taking advantage of the current weakness to build their positions. The key support level to watch is the recent low of $81,000, which was tested on November 21st. This level represents a critical line in the sand for the bulls. A break below this level could open the door to a further decline towards the $75,000 to $78,000 range, where there is another cluster of support from previous price action. On the upside, the immediate resistance lies at the current level of $91,000 to $92,000. A decisive break above this level, confirmed by a surge in trading volume, could pave the way for a move towards the psychological resistance of $100,000. This is a level that has captured the imagination of many investors, and a break above it could trigger a powerful rally driven by FOMO or fear of missing out. The Relative Strength Index, or RSI, is currently sitting at around 45 on the daily chart, indicating that Bitcoin is neither overbought nor oversold. This suggests that the market is in a neutral state and that it could move in either direction depending on the next catalyst. The Moving Average Convergence Divergence, or MACD, is showing signs of a potential bullish crossover, which could be an early signal that the momentum is shifting in favor of the bulls. Let's take a moment to reflect on the predictions we made back in October when the market was riding high and optimism was abundant. Many analysts, myself included, were calling for a move to $100,000 and beyond by the end of the year. These predictions were based on the historical precedent of the Bitcoin halving cycle, which has consistently led to new all-time highs in the months following the halving event. The halving, which occurred in April of this year, reduced the rate at which new Bitcoins are created, thereby reducing the supply and, in theory, increasing the price. However, the macroeconomic shock of the renewed trade war and the subsequent market turmoil have invalidated these optimistic forecasts. The market has a way of humbling even the most seasoned analysts, and this is a reminder that no prediction is certain, and that we must always be prepared to adapt to changing circumstances. But this is not a time for regret, but for learning. The lesson here is that in today's interconnected world, no market is an island. Crypto is no longer a niche asset class, but a global macro asset subject to the same forces that shape the traditional financial markets. Our new projections for the year end now range from $80,000 to $100,000, a more cautious but realistic assessment of the current market conditions. This range reflects the uncertainty that pervades the market and the fact that the outcome will depend on a number of factors, including the Fed's policy decisions, the trajectory of the trade war, and the overall health of the global economy. Now, let's consider a hypothetical scenario that will help illustrate the importance of timing in this market. What if you had invested $100 in a spot Bitcoin position at different point in the recent market cycle? If you had bought at the all-time high of $126,000 in early October, When euphoria was at its peak and everyone was predicting even higher prices, your $100 investment would now be worth approximately $72.50, a painful 27.5% loss. This is a stark reminder of the dangers of buying at the top, of succumbing to FOMO, and ignoring the warning signs. However, if you had bought the dip on November 21st at $81,000, when fear was at its peak and many were predicting even lower prices, your $100 would have grown to approximately $112.80, a respectable 12.8% gain in just 1 week. This demonstrates the potential rewards of buying when others are fearful, of having the courage to go against the crowd. And if you had invested at the current price of $91,355, you would be at break even, neither making nor losing money. This simple exercise illustrates the critical importance of timing in this market. It's not just about what you buy, but when you buy it. The difference between a profitable trade and a losing one can be a matter of days or even hours. This is why it is so important to have a clear trading plan, to understand the technical and fundamental factors that drive the market and to be disciplined in your execution. So, where do we go from here? This is the question that is on everyone's mind, and it is a question that does not have a simple answer. Let's explore some potential trading scenarios for the coming week, each with its own probability and set of triggers. The first scenario, which I assign a 40% probability, is one of continued weakness. In this scenario, Bitcoin breaks below the critical $80,000 support level, triggering a further decline towards the $75,000 to $78,000 range. This would likely be driven by a renewed sell-off in the US equity market, perhaps triggered by disappointing economic data or by a hawkish statement from the Federal Reserve. It could also be driven by a worsening of the global credit crunch, which would reduce liquidity and increase risk aversion. In this scenario, Ethereum would likely follow Bitcoin lower, potentially testing the $2,500 to $2,700 range. This would be a painful scenario for many investors, but it would also create opportunities for those who are prepared to buy at lower levels. The second scenario, with a 35% probability, is one of stabilization and recovery. In this scenario, Bitcoin consolidates within the $85,000 to $92,000 range, building a base for a potential move towards the $100,000 level. This would require a stabilization in the US tech sector, which has been a major source of weakness in recent weeks, and a clear signal from the Federal Reserve that it is prepared to support the market. It would also require a resolution, or at least a de-escalation, of the trade tensions between the US and China. In this scenario, Ethereum would likely consolidate within the 2,900 to 3,200 range, and altcoins would begin to show signs of life. This would be a more constructive scenario, and it would suggest that the worst of the selling is over. The third and most optimistic scenario, with a 25% probability, is one of a rapid recovery. In this scenario, a positive surprise in the inflation data, such as a significant drop in the CPI or a dovish pivot from the Fed, such as a commitment to further rate cuts, could trigger a powerful rally, sending Bitcoin soaring towards the $110,000 level and beyond. This would be driven by a flood of institutional capital, eager to capitalize on the discounted prices and to position themselves for the next leg up in the bull market. In this scenario, Ethereum could rally towards the $3,500 to $4,000 range, and altcoins could see explosive gains. This would be a dream scenario for many investors, but it is important to remember that it is also the least likely of the three scenarios. It would require a significant shift in the macroeconomic environment, and it would require a level of optimism that is currently lacking in the market. As we navigate these uncertain waters, it is crucial to have a clear set of technical triggers to guide our trading decisions. These triggers are the signposts that tell us when to enter a trade, when to exit a trade, and when to sit on the sidelines and wait for a better opportunity. For the bulls, the key trigger is a decisive break above the $92,000 resistance level, confirmed by a surge in trading volume. This would signal that the bulls are back in control and that a move towards $100,000 is imminent. A secondary bullish trigger would be a successful retest of the $85,000 support level, which would demonstrate that the market has found a solid base and is ready to move higher. For the bears, the trigger is a break below the $80,000 support level. This would be a clear sign of weakness and would likely lead to a cascade of selling pressure as stop-loss orders are triggered and leverage positions are liquidated. A secondary bearish trigger would be a failure to reclaim the $92,000 level after a rally, which would suggest that the bears are still in control and that the market is not ready to move higher. In this market, it is not enough to be right, you also have to be positioned correctly. This is a time for discipline, for patience, and for a deep understanding of the technical and fundamental forces at play. In conclusion, the past week has been a microcosm of the crypto market itself, a volatile, unpredictable, and yet endlessly fascinating space. We have seen the market plunge into the depths of despair, only to rise again with renewed vigor. We have seen the interplay of macroeconomic forces, geopolitical tensions, and institutional maneuvering. We have seen the power of fear and the resilience of hope. As we look ahead to the coming week, we must remain vigilant, adaptable, and intellectually honest. We must be prepared for any eventuality, and we must have a clear strategy to capitalize on the opportunities that will inevitably arise. This is not a market for the faint of heart, but for those who are willing to do the work, to put in the hours of research and analysis. The rewards can be immense. Remember, the key to success in this market is not to predict the future with certainty, but to understand the probabilities, to manage your risk, and to position yourself to take advantage of the opportunities that the market presents. Thank you for joining me on this journey into the heart of the crypto market. I am Boni, and this is Boni's Life. Until next time, trade safe, stay informed, and may the profits be with you.